If you decided you wanted to learn how to invest, what would you do? Would you try to look at charts and try to trade like a technical analyst? Would you try to predict the cash flows of the money within an economy? Or would you try to evaluate individual businesses? Most people end up looking at the most well-known and most successful investor, Warren Buffett. When people hear Buffett talk about his strategy, he talks about his current strategy. And people think that's the strategy they should be using, but that's just a misconception. When Buffett talks about buying great businesses at a fair price and holding them forever, he's speaking about his current strategy. But as a small individual investor, you should not be following this strategy. And I'll tell you why. Better yet, Buffett and his late partner, Charlie Munger, will tell you why.
I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it. You've got to, when you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals, and I did it twice. And I actually looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. There's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Charlie?
Well, yeah, I think that's right. A brilliant man who can't get any money from other people and is working with a very small sum probably should work in very obscure stocks, searching out unusual, mispriced opportunities.
There are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true. I mean, it was over the years, as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than $100 million. But that is not.
15 of 2018, you mentioned that you guarantee you could make a 50% annual return if you had to start again with under $1 million. What method or methods would you use to achieve that return? Would it involve flipping through 20,000 pages of Moody's manual or similar publications, or finding, to bicycle butts? Or would it be hunting for great companies at a fair price, as Mr. Munger would? Or would it be a combination of both, with opportunity cost serving as the final arbiter of which method to use, given that your investing opportunity has now broadened significantly? Thank you. Cop and Cap.
Good question. I'm glad you came. The answer would be, in my particular case, it would be going through the 20,000 pages.
I've taken this advice to heart and been focusing on these tiny stocks. You see, Buffett is restrained by the amount of capital he can invest with. He can only invest in large and mega cap businesses. The larger and more followed a business is, the more likely it is to be priced correctly, and the smaller the return that is promised. Buffett's returns over the last few decades are evidence of this. Buffett has barely been able to beat the average market return by a few percentage points, compared to right after he learned from his teacher, Benjamin Graham, in the 1950s, when he was making an excess of 50% returns. So on this channel, we're focusing on these small, obscure, mispriced opportunities because this is where most of the highest return opportunities are present. I'll quickly explain the two types of business valuation structures and position sizes so it's easy to understand everything on this channel. A business is generally valued based on the cash flow or earnings it will produce in the future, but the lowest floor of how much a business should be valued at is for how much the business would liquidate for. That's basically what we're looking for on this channel. So far, since I've switched to focusing on these tiny stocks in 2023, my returns have been multiple times the average market returns for those years. So on this channel, we look for tiny businesses that are either priced much lower than the cash flow will produce in the future, or they're priced much lower than the business would liquidate for. Very simple valuation concepts. The first valuation method is called discounted cash flow calculation. The second is called book to liquidation value. I split my positions sizes based on the type of business and type of risk, but I do like to be concentrated. The smallest position size I will take is 5.5%, and the largest is 50%. If this kind of thing interests you, please check out some of my newest uploads to see what I've valued and how my portfolio is performing.